So imagine we're moving one of these logs out of the water so we can free up this trash down our boom, and we slip and fall with it and crush our leg or break an arm. This never happened, by the way, Lord willing. In such a scenario, how am I going to continue to work on my business? How am I going to be able to generate income? Let's get into short-term and long-term disability for both employees and business owners. Now, disability insurance is only designed to replace the income of the employer or worker. It differs from workers' compensation in that you don't have to actually get hurt on the job site to receive benefits. Now, short-term disability coverage is income replacement insurance with a shorter elimination and benefit payout period. The elimination period refers to the amount of time you have to wait until you start receiving payout for your injury. On average, about 14 days for short term. Benefit period is how long you receive those payouts. Usually no more than 2 years. Long-term disability is a longer elimination period, usually about 90 days. Much longer payout period, usually between 3 and 5 years, although I've seen them as high as 10 years. These policies are used by employees and both business owners in a few ways. One, the business can help the employee take a policy out of themselves so that they can replace their income if they were to become short-term or long-term disabled. They often will even contribute to the premiums of those. But two, in reverse, the business can take the policy out on the employee for the business. This would be to replace the monetary value of what that employee's role was producing to the company in revenue. Then an even larger pending risk is what happens to co-business owners who become disabled. So the co-owners can purchase policies on each other in order for them to be able to continue to pay the salary on one of those owners like they would an employee. We often include a stipulation in that policy that if the disability lasts longer than 12 months, a disability buy-sell transaction will be triggered. This is when those payments are then used either as a stream or as a lump sum by the disabled partner out of their shares in order for the company to retain control amongst the active owners. And having this type of risk mitigation for a business is huge when you have multiple owners.